Hello everyone. Welcome to our review of the practice. So our intent here with this practice is that you get some sense of how to apply the principles of accounting to actual financial statements. So as you'll recall, flipping back to what you should have already reviewed, these PowerPoint slides, this particular slide in particular gives us all of the terminology that we like to use. And we talked, and there was definitions about it, but you also remember that we had this document that you should have reviewed already and watched a podcast about, which describes the way that the concept statements work in US GAAP. So notice this has some of the same information as our PowerPoint slide, but it's not as visual, you might say, but a little more description, okay, a little more information. So applying that to American Eagle, we're going to their 2022 last annual report, and they have the financial statements starting on, you can see this was the page before was 42. So lots of things before that. Starting on page 43, there's a balance sheet, as we're familiar with. Assets, liabilities, owner's equity. Statement of operations or income statement. The next statement given. And notice that as we always, in the past, when we've looked at these in other earlier classes, we probably ignored the idea that it said refer to notes to the consolidated financial statements. So in intermediate, we're going to hopefully expand our understanding of what is being presented here, okay? And by learning how the footnotes work and how they apply. So as you look at this, anything that is here has fit the definition for what it's there for. So it is being recognized. It has been presented in the way that the company has determined should be properly presented based on what it is. So as the assets are with the assets, the liabilities are with the liabilities, revenues are with the revenue. And the amount here could be measured and was measured appropriately according to US GAAP rules. And then any additional information you need about it to understand it is in the notes. So our statement of income statement of comprehensive income, will be a little unfamiliar. We will be covering that in some detail in a couple of weeks as we go back through these financial statements. Statement of changes in stockholders' equity, or just a statement of stockholders' equity for short, and the statement of cash flows. So absent the statement of comprehensive income, those should be familiar. Again, it's a little complicated more than the ones we've got used to because they present multiple years together, and we talk a little bit about why. But then the footnotes. Usually one or two, first two footnotes, sometimes they will skip this business operations footnote and go right into the summary of significant accounting policies, or some other very important information will be in number one, some change or whatever will be in number one, and then they'll get the summary of significant policies. But this talks about how big and what their operation, what they do at American Eagle Outfitters, so we can kind of understand where they're coming from. And then let's start talking a little bit about how these footnotes might indicate how American Eagle applies the accounting principles to their particular situation. Okay? So, looking at principles of consolidation. the consolidated, and we all talk this term consolidated financial statements. Sounds like a mouthful, but what that means is all of the companies, subsidiaries, all of the pieces have been included. So we have been, you might say, complete, okay, to make sure that it is reliable. We haven't left anything out that we own or control, okay? So that's important to realize that there's no part of our business, some part of the business owned over this direction. It may not legally be the same name or the same exact corporation, but the same shareholders own both. And therefore, it is consolidated or added in, because things that happen to that piece of the business could impact the whole. So we've included all of those. So that's way of them telling you that they have been complete in presenting and including all of that. So their presentation, because they really think that that's relevant to your decision making, and you can rely that there's not, that nothing left off that would be important. Okay. Then of course we need to know the time period. Why? So we know how timely this information is to make decisions. If we're using it to predict the future, we need to know what it is that the future, where we are in time, so we know what the future is. Okay? Not to mention that each of the time periods are comparable. We're not comparing 3 months of sales in 1 year with 6 months of sales in another year. We're comparing a whole year's sales to the whole year of the whole next year's sales. So those are important pieces that may seem kind of obvious, but would clearly be problematic if we're ignored. So first two are a little bit straightforward. Okay, estimates, the idea that we estimate sometimes in accountings because we don't know everything that's going to determine the amount. Okay, so remember, the amount that we put on the balance sheet is how we measure something. How are we going to measure how much of the stuff we sold on credit is going to be paid to us? Well, we don't know that for sure until we receive it all. But we need to be timely with our information, so we make an estimate of what we aren't going to receive. We do as good a job as we can, because to estimate that, making it as verifiable as we can, knowing that it's not perfectly verifiable until the money comes in. And put that on the balance sheet as a presentation, usually with an allowance that we learned about in earlier accounting classes. So what about recent changes in accounting? You notice that we tell people that we have applied new standards. So when the Financial Accounting Standards Board issues new rules, American Eagle or whatever company you're looking at is going to have to apply those. That may make things be a little different than what investors have seen in the past, depending on the situation. So that would be here, so that we know how to compare this one to the past, because we want to be consistent from year to year, so that we can make those comparisons. Moving on, and again, many of these actually will have additional footnotes that explain it in even more detail. So these are sort of the summaries, and then there'll be additional later. And some of them even tell you the actual place in the codification that we talked about in this section of intermediate accounting, where it they got the rule where they went to refer to the rules. For instance, this one on foreign currency translation, they went to ASC. When you see ASC, that is how things are referred to in the codification, 220. And then they put it in italics to make it even more stand out even more. So if you wanted to now know how much foreign currency translation affected American Eagle, and of course, the more the company does business over in other countries, the more it's affected. Then you would go to this footnote. This doesn't give us much dollar amount; it just gives us a little bit of a summary. But it tells us how they measure, because this is an important measurement concept. If you're making sales in a foreign currency, how did that get reflected and measured on the financial statements when the financial statements are presented in dollars? There has to be some kind of translation from those indications to the others. Or if the business entirely home currency is euros, then of course, if they do transactions in dollars, they do have the same thing. They have a translation issue. It works either way. And then you'll see that they're going to give you the definition. What they consider fits the definition and how they apply the definition of things that should be very familiar to you. Cash and cash equivalents, accounts receivable, merchandise inventory. What does that mean? When do they recognize that? How do they measure it? For instance, it'll tell you which LIFO, FIFO, or weighted average they use. Okay, for instance here, average, and that they always are looking for the net realizable value, which means if the value is dropped, they're going to record a loss, lower of cost or market, that you've learned about in earlier classes, and we're going to learn again a little bit about in our chapter on inventory. So those are ways that those things were measured, how they were presented on the financial statements. Okay, so just a quick, maybe the simplest thing here. So, okay, first of all, cash and cash equivalents. Company considers all highly liquid investments, maturity of 3 months or less, to be cash equivalents. That's the definition. That's what fits that we recognize. It's where they've put their money that they don't need right away. Okay, and they even put another footnote. Okay, with some more detail. So let's just scroll down to footnote 4. And you see there's a whole bunch of other explanations. So I'm going to do this quickly. And there's cash and cash equivalents. What have they done? They broke it into cash and interest-bearing deposits. Cash being checking accounts, probably. Okay, because checking accounts don't bear interest, and interest-bearing deposits being savings accounts, other short-term, maybe money market accounts. And you see it's about half and half. Why do they think you need that disclosure? Okay, they think that's relevant. You know that they are keeping the money that they have until they need to use it to pay the bills. Okay, so the definition was up here in this summary to describe this number on the balance sheet. So 172.09. Okay, is first you give the definition. In this summary of accounting policies, that fits according to the principles as an asset, fits the definition. We recognize it as presented, very first line on the balance sheet, as the most liquid of our assets. And we even show you some disclosure. Okay, we measured it. We did not. It's exactly what is in the banker in their investments. There is no allowance. There is no losses on these. Okay, going forward, just scrolling down a little bit further. You see there's definitions about how they calculate depreciation on property and equipment. Consider that an asset. How they came up with an estimated amount. So that, why did we need to know that? That tells us how they presented that, how they measured depreciation, a measurement issue. As far as an expense, it also affects the balance sheet because you use accumulated depreciation to reduce the asset amount. And then you see it kind of gets harder as we get down the balance sheet. You can see these explanations get bigger. I mean, I should say have more words, however you want to look at it, more complicated. You'll see that at the end there's even more. Besides this long explanation, there's more in note 8 and note 17, okay, about impairments that we'll learn about later in this class, okay. This goodwill has reference. This is what rule they're using, ASC 350. We can look that up in the codification. And they also have reviews Note 9. Again, they're talking about how we determine what the asset was, how we show it's been used up, so we know how much to measure that, what its amount should be presented, where it should go on the balance sheet. And this is our additional disclosure. And there's even more additional disclosure further down. See some interesting things that may be unique for this company. Self-insurance liability, kind of a complicated issue where instead of paying an insurance company, they just do their own. They cover losses that would be usually reported to insurance. They just take care of them themselves because they have cash flow to do so. Well, there is liability that's there that has to be estimated. Okay, how did they come up with that? How do they measure that? That's going to be explained in a very broad way here. Leases, same way. They lease a lot of that. How did they come up with the definition? How's that presented on the balance sheet? Okay, there's going to be a whole note, and it's going to show that those things that they lease are going to be shown as assets and liabilities. Okay, how they handle credit cards, their loyalty program, okay, and how the revenue when somebody buys a gift card or it becomes a part of their rewards program, they call it, I guess, real rewards, gain points, or however you measure it. That program, in theory, there's a liability there that has to be measured. How do they come up with that? And this will give you some insights about that amount, what amount should be presented, how they come up with that. They have to estimate returns under our measurement of revenue. They estimate what percentage of the stuff they sell is going to come back. And then when it does come back, they take it out of that estimate. And when we sell more, we make additional estimate. Long-term debt, income taxes, other things that specifically have general principles that determine what is relevant, what we want to know about long-term debt, how much is on the balance sheet, how much is actually owed, all of those things. And again, they refer to additional footnotes. Revenue recognition. Now, even the income statement, we have definition of what goes into cost of goods sold, what goes into general administrative expenses. How they know how much expense there was. A measurement issue. What about how they handle advertising costs? A huge part of their costs. Interest expense. And then just perhaps our last one, before just scrolling a little bit further down, is legal proceedings. Okay, just to kind of encapsulate kind of how this works. Again, they're going to refer us to a part in the codification, ASC 450, called contingencies. All right, they record a reserve to, and when we say reserve, think liability, an estimated liability that is what they're going to have to pay out to pay off those who have sued American Eagle for various things. They did not see any one case as being big enough, having materiality sufficient to mention specifically, but they are always being sued. Okay, and they've looked at all of those, and what this tells us is they've looked at all of those, and they've estimated how much they think they're going to have to pay out on the ones they're going to either lose or settle. Okay, and so that range of possible losses was probably huge, and they have chosen an amount, because you can't actually present on the balance sheet a range of amounts. You have to present on the balance sheet an amount. And how do they measure that? They used a number at the low end of the range, because they figure that they are not going to lose them all, and and most of them will be settled at a fraction of what the people are asking for in court, which is typical. So they're going to record that at the low end of the range. So what are they saying here? Okay, they've done their best job to figure out what was material. That's what they're claiming, at least. Okay, and that they've left nothing out that is material. So they've been complete, so that you can rely that these financial statements are not going to substantially change when the outcome of these lawsuits actually happens. So 3 years from now, the possibility that something will be settled for many times more is very remote. Okay, not impossible by any stretch, but is fairly remote. Enough that we can go ahead and use this information to make relevant decisions, to predict the future, and that we're not going to have some payout at an existing lawsuit right now that's going to surprise us. Okay? And we've measured that. We've recognized that as a liability. We present it as part of our balance sheet and our income statement, probably in there as other liabilities and in other expenses, because it's not that material. But we didn't want to leave anything out. We want you to know that we considered the possibility for full disclosures. Okay, so we've given you that idea. So that's kind of how it all works. And then, of course, you have all the other footnotes that they're referring to about financial instruments, and you see there can start to be little tables about how and the amounts and how they were calculated, and so forth. We are going to look at most of these footnotes type of information as we go through the rest of the semester. It is also the basis, and looking at the footnotes, the basis for the Walt Disney Financial Disclosure Report that you're going to do in groups as we go forward, and will be due at the end of this semester. So this is where we start building our building blocks for being able to understand these footnotes well enough to be able to explain them how they apply there. Okay, so this is hopefully what you got. We're able to pick at least some of this out of the American Eagle report. Again, it's not this is just practice. This examples, the stuff that you will use for homework is not as it's a little shorter. You don't have to look at all of the footnotes. We've just given you some selections from footnotes that I found, but changed the names of companies and things a little bit. And so that's what you're going to practice with. You're going to do with homework. Kind of the same idea, looking through, thinking through the situation. What does it apply? What principles? What things on this sheet is it describing? Okay, and that's what we wanted to practice here as well. Hopefully, this gives you some insights and something to work towards.